So in this video, I want to prepare you for all the different possibilities and just to show historical comparisons. The first thing I want to say is you shouldn't do anything I say. I don't want to be responsible for the decisions that you make. You can do whatever you want. If you want to buy, if you want to sell, right? We're all speculating in the end of the day. No one knows with absolute certainty what's going to happen. But you can look back at history, you can assign probabilities to certain outcomes. Um, because certain things do repeat themselves a lot, such as the business cycle. And while everyone is distracted about or distracted with the tariffs and Trump's role in this shouldn't come as a surprise to you, right? We have been talking about a lot of these things that are happening right now, such as the unemployment rate going up and deflation and GDP contraction and all that, right? The first thing I want to point out is if we look at the S&P 500 here on the daily, right? From the peak, okay, the S&P 500 fell 22%. This fall is consistent with the first move down in a 50 to 60% overall bear market that takes, let's say, a year to 2.5 years. The only thing that would make this comparable to the Great Depression from a drawdown perspective is if we keep going down right now. So if you're expecting a overall 50 to 60% drawdown, we've already done the first move that had to be done. Because what we're gonna do is we're gonna go back and we're gonna look at history, okay? And I just want to go over 2008 here and say that the first move down here, the market peaked in October 2007. The recession began later in December 2007 when GDP contracted, which is what we also have right now. The first move down in 2008 was 19.5%, but this took 105 days. The current move that we just had, that was down 22%, which is deeper, okay, took 47 days. So you see how quickly we have gone down compared to in 2008. Now, I want to prepare you for every outcome because you got a nice bounce here of 10%. Then he sold back out to the low, right? Then he bounced back up. Pay very close attention to this high here. Okay? This lower high here. How much lower is that high from the all-time high? 8.5%. 220 days in to the bear market. The bear market didn't begin down here. It began up here. Okay? So as long as you don't take out the all-time high, nothing has changed. Alright? Let's be very clear about that. But if we were to have a similar scenario where 220 days in, you're down 8.5% from the all-time high, just to put it into perspective, alright? 8.5% down, 220 days in. You can literally do this. I'm not saying this is gonna happen, but you could do that. We're at 5,600 on S&P by September, early October, right? And you're still in a 2008 style crash scenario, right? Now let's go to the dot-com bubble burst. Well, first of all, what came after that drop? Well, that's where the capitulation comes, because the capitulation is when you drop, you know, say 50% in half a year. So you could be up at 56. I'm not saying it's gonna happen, but if you repeat the same thing, right? And I already know what people are gonna say. They're gonna say, "Oh, you see the rally, bro? We're not down that much. It's not that bad." You could have made the same case right here. All right, all right. Let's go to 2000. The first move down, sustainably. Yes, we had a move down here, but the first move down into bear market territory, 20% down, which is not even quite 20%, 18% down, took 111 days. Again, we went down 22% in 45 days. All right. Then you bounced back up hard by 10%. Then it dropped again. Then it pumped again. Then it dropped again. Right? And it just kept going lower for years. Okay? This bear market took 2 years and 7 months, from March 2000 until October 2002. This one took 18 months, from October 2007 until March 2009. And then, yes, you can compare it to this if you want. However, this is nothing like what we had back there, and I can provide an example. Okay, first of all, the market is incredibly overvalued right now. It's not fair to make a comparison. In 1990, the market cap to GDP ratio, which again, Warren Buffett says that this is probably the best single measure where valuations stand at any given moment. Okay, at 200% market cap to GDP, you're playing with fire. Okay, I don't think that Warren Buffett said you're playing with fire. All right, if the ratio approaches 200%, you're playing with fire. I don't think that he said that to have a little nice move down here, and then that's it. All right. Where silver value, that mean is at 85% roughly. All right. Well, we were at 207%. What does that require? A 55 to 60% drawdown from the peak. So comparing it to 1990 is silly, and same with all of these recessions that happened in the 70s and in the 80s and so on. It's just silly, right? But let's look at this 50% drawdown right here. Again, the market was cheap in 1974. Look at this. You see how cheap it was? Like 40, 50% market cap to GDP. We were at 210%. All right, just look at this. First drawdown. Let's say it stopped here temporarily, right? Yeah, you made a new low, but let's just measure this. 17% on the way down in 179 days. Then you bounce back up. And you can be this deep into a recession, 290 days into it, and you're only down 7.5% from the peak. But then the fall comes, and this was overall decline of 50% as well. And market was cheap there. Right? Even at the peak, it was cheap because of all the inflation that happened in the 1970s. And look at the market cap to GDP ratio. So this is just to put it into perspective, right? Now, what is comparable to 2008? First of all, as I brought up, we had deflation now. Okay, the issue with deflation is this marked the first decline in consumer prices since May of 2020. This shouldn't surprise you because I've been talking about this. Here's the money supply. Everyone likes to talk about the money supply going up, and that's bullish and inflationary. But then they don't want to discuss when the money supply went down. Okay, so you might go, well, what do I care about what happened between December 2022 and March 2024, right? Because there's a lag effect. CPI, year over year, trading economics. I want you to pay attention to the lag effect. Okay, let's go to the past 5 years. First of all, let's go back on this whole chart here. We never had any contraction on this whole chart here, alright? Until here. Now, pay very close attention. In February of 2021, the money supply was growing at 26.7% year over year. What was the inflation rate in February of 2021? 1.7%. Now I'm gonna bring up something that Milton Friedman published. So Milton Friedman, legendary economist. There is much evidence that monetary changes have their effect only after a considerable lag and over a long period, and that lag is rather variable. In the National Bureau study, on which I have been collaborating with Mrs. Schwartz, we have found that on average of 18 cycles, peaks in the rate of the change in the stock of money tend to precede peaks in general business by about 16 months, and troughs in the rate of change in the stock of money to precede troughs in general business by about 12 months. For individual cycles, the recorded lead has varied between 6 and 29 months at peaks and between 4 and 22 months at troughs. Monetary and fiscal policy is rather like a water tap that you turn on now and that only starts to run 6, 9, 12, 16 months from now. It's because of this long lag in the reaction to policy that you have this tendency for policy to in fact have an effect opposite to that intended. Or, again, thus you have a situation such that when the Federal Reserve System takes action today, the effect of that action may on some occasions be felt 5 months from now, in other occasions 10 months from now, in other occasions 2 years from now. That is the major reason why it is so difficult as a technical matter in the present state of our knowledge to know what measures one ought to take at any given moment. So if the money supply is growing at 26.7% year over year in February of 2021, and inflation is 1.7%, why is it that inflation started going up after that? Because there is a lag effect. All right. So if M2 money supply going up equals inflation, because you have more currency units chasing fewer goods and services, there's no bias here. Okay. You also have to conclude that then this has consequences with a lag. So you saw the lag with the M2 money supply increase and its effect on inflation. What about this contraction in money supply between December 2022 to March 2024? Well, based off of history, every single time you have a money supply contraction, you get a recession or depression. 10 out of 10 times here in the past 200 years. It has never not been different. So you might say, well, it says here 2022, 2023. Yeah, because it happened late 2022, right? Late 2022, 2023 into 2024. And if there is a 2-year lag effect, this is what started to show up. So while everyone is distracted about Trump's tariffs and so on, right? Yeah, they matter and they can turn a recession into a depression. And I've factored it into my analysis because I've made comparisons to the 1930s. How you have a stock market bubble, you had the record yield conversion when the stock market went up for 2 years during it. Then you had the Republican president that took over and implemented tariffs, and that popped the bubble. It's like, this is nothing new, but pay attention to the money supply, right? So that stayed contracted from December 2022 until March 2024. That's going to lead to consequences. And that's currently what we're seeing in the in the inflation rate. And if you go back, right, every single time in all of these examples you had deflation. You can still have deflation without a money supply contraction, but a money supply contraction guarantees it, and it guarantees a recession or a severe recession or depression. And the reason for this is because, again, Bernanke pointed this out. Deflation, making sure it doesn't happen here. He was the Fed chair during the global financial crisis, and he said this in a speech, right, in November 2002. Right? Sustained deflation can be highly destructive to a modern economy, should be strongly resisted. So the issue with deflation is that if there's an expectation that prices are going to come down, then people are going to stop spending. And if they stop spending, it leads to more layoffs, right? Because you have less consumption in the economy. Same thing with tariffs. Tariffs lead to less consumption. Less consumption leads to job losses. More job losses leads to more, or even less consumption in this case. So this is the problem with deflation. This is the problem with tariffs. And I don't know about you, but everyone who says tariffs are inflationary, first of all, they don't really understand inflation. Inflation is not the same as a price increase. If the consumer has a set amount to spend, that's it. He doesn't have more, right? And that's not how it works with tariffs. You have a price increase in some things, which again affects the supply and demand dynamics of certain goods, but that affects the supply and demand dynamic of other goods and services. So the general price level stays the same because you never added more currency units to circulation, which is really important because a price increase is not the same as inflation. And the 1930s didn't go down as an inflationary decade the last time we had tariffs. It went down as a deflationary decade. And right now we have deflation. So this is not good, right? And then where are we in the business cycle? Let's be very clear, okay? Because we can sit here and blame it on whatever we like to blame it on. It doesn't really matter. Pay attention to the business cycle. Like we've been talking about this. This is to be expected, right? When the Fed funds rate in red goes down, while the purple line moves up, which is the unemployment rate, The Fed funds rate is going down in reaction to the 2-year Treasury yield, which is the yield curve re-steepening in this case, bull steepening. And then you have the unemployment rate moving up. What happens to the stock market in every example? Right here, when the Fed funds rate went down, unemployment went up in purple, stocks sold off, you got a recession. The green vertical shown as GDP contraction. Here, right here, the Fed funds rate was going down. The unemployment rate was going down. So why was there no recession? Because the unemployment rate was going down. Stock market went up. There was no inverted yield curve prior to this either. All right? But right here, you had the unemployment rate moving up with the Fed funds rate moving down. You got a recession and the stock market went down. Right here, you had the Fed funds rate going down with the unemployment rate going up and the stock market went down. Right here, you had the Fed funds rate going down with the unemployment rate going up and the stock market went down. Right here, you had the Fed funds rate going down with the unemployment rate going up and the stock market selling off. It's just doing what it's always doing, right? So it's still come to the conclusion that all of this is happening because of Trump. Like, are you paying any attention? A recession is a negative GDP, which we have according to the Federal Reserve. This has 99.5% accuracy in forecasting what's going to happen to the GDP number. They use the same data as the Bureau of Economic Analysis, the BEA, that published the GDP data. The problem with the GDP data is, let's say that, now this didn't happen for this quarter, it started contracting in late February. But let's say, hypothetically, if it started contracting in early February, you won't know until a month after the quarter is over, so late April. That's a huge lag effect. So that's why GDP now is useful. All right. Now what I want to pay attention, or what I want you to pay attention to, is what's happening to the yield curve. Look at the yield curve, okay? And here's the unemployment rate. Do you notice something between these two lines? Let's smooth this up for now. I don't want it to be distracted. Do you notice something about these two lines? Notice how they're correlated. Do you see it? So in regular candles in white and yellow, you have the yield curve. When the yield curve gets inverted and stays down here, the unemployment rate is at a cycle low. When the yield curve comes out of inversion, the unemployment rate moves up. Same thing right here. Same thing right here. Same thing right here. And the same thing right here. So what is the problem here? Well, in all these other instances where the yield curve is spiking like this, okay? And like it's doing right now. What happened to the unemployment rate every time? It started spiking. The issue with that is that the stock market does not like that. And what I'm referring to is this. One sec. Let me just fix this. And then add the US recessions. It's a clear pattern, and it's clear as day. And you can blame this on Trump as much as you want. It doesn't matter. What's going to matter by the end of this is if you have lost everything, or if you're going to be able to take advantage of the opportunity. Now, I don't know if the stock market goes down the average recessionary decline of 35%. It would seem like that's silly to expect given the overvalued stock market, right? We're in a bubble, and bubbles pop hard. When the yield curve goes out of inversion, the unemployment rate goes up in purple, the stock market goes down. You get a GDP contraction, which is the green vertical zone. Okay, so inversion of the yield curve, GDP contraction 6 to 24 months later with rising unemployment. Yes. Inversion of the yield curve, sustained inversion in the yield curve. What happened? Unemployment rate up, stocks down, green vertical zone, recession. Inverted yield curve 6 to 24 months later. And might say, yeah, but this has been inverted here since like late 2022, early 2023. Yes, this was inverted in January 2006 as well. Okay? If you want a timing signal, look when the green bars appear. They appear when the yield curve comes out of inversion. You see? And as the unemployment rate moves up, stocks sell off. And same thing right here. When the yield curve comes out of inversion, the unemployment rate goes up, stocks go down. When the yield curve comes out of inversion, unemployment rate goes up and follows the yield curve, and stocks sell off. It's the same thing as every time. And if the green vertical zones represent GDP contraction, well, what do we have? It's here for you to see yourself. So if you think that the market is just the only thing it cares about is the tariffs, you're really hurting yourself. Okay? As I wrote here, the early candle is at the 10-year, 2-year yield curve spread. Anything below the green horizontal line is an inverted yield curve. It's the warning sign. Bull steep and above neutral delta is the timing signal, which means unemployment is going to follow the yield curve and stocks sell off. In red, you have the S&P 500. In the purple, you have the unemployment rate. The yield curve plus the unemployment rate is bad for stocks when they go up. What's happening right now, especially with negative GDP for Q1 being twice as bad as 2008, will likely result in a generation learning a hard lesson. All right. So if you're waiting for me to tell you where the bottom is, I don't know where the bottom is. I can use technicals at that point and I can speculate, but I don't know. I can tell you what I'm going to be buying. I'm going to buy the S&P 500 if it gets cheap. And by cheap, I'm just talking about it's not even really cheap, just back to normal market cap to GDP, because Warren Buffett tells me this is the best thing to look at. If it doesn't get down there, that's fine. I'll buy something else. I'll probably buy silver. Is silver gonna go down? Normally does in recessions. I'm not gonna buy crypto. Okay, they're Ponzi schemes. I'm 70% of the way to where I wanna be, so I don't have to take on that additional risk. You can do that if you want, but I don't care about where crypto goes. Okay, I don't care about the tech stocks. I care about the S&P 500 and silver. So hopefully now you're starting to see what's going on here. And so while everyone else is distracting you with it's the tariffs, this, tariffs, that. Then why is the stock market down 15% from the peak right now in a month and a half? Which, based on previous business cycles, that's not a good thing. But again, you could make a lower high in months from now that's 8% away from the all-time high. I showed you examples of where that happened during a 50 to 60% overall decline in 1974, 2000, and 2008. And pay attention to the depth of the inversion before the GFC. Pay attention to the depth of the inversion here. So concerned the bond market is about what's on the right side of the chart, right? So it's really important to remember this. And it's the same story as every single time. It just ends in some tragic outcome. But again, guys, I don't know how deep the stock market goes. I can guess and I can look at the valuations and I can say if it goes back to normal, this is what I would do. But I don't know these things, okay? And no one does. You can use technicals, and I'll provide you examples of what I would be looking for from a technical perspective. But I shouldn't do anything that I say, right? I'm just gonna share my analysis. That's all. Okay? You're basically in here, okay? And you can bounce hard and like, look, you don't sustainably break below here for like 9 months. You're basically in here, and you break below that low in like 2 months later, right? And in 1974, where are you? If you were to make a comparison to that as well, you're like in here, and you don't have to take that low until 5 months from now. But what I'm looking for is there's a few things here, okay? So I don't want you to do anything that I say, but I'm just gonna share the logic behind this, okay? This is Japan's stock market. So the reason why we have a bubble is because people borrowed cheap yen to buy assets around the world, right? As Japan starts to deleverage, the whole world does, and you get forced selling at the same time. It's the forced selling that you want to buy into. This is very perverse, but this is the way it works. If you want the best opportunity, you want to buy when people lose their jobs. You want to buy when the VIX is spiking along with it, and it can stay elevated. In 2008, the VIX stayed above 50 for 3 months. And then you're looking for other technicals. So I'll give an example, okay? So I'm not pointing this out right now. I pointed it out way up here, as I pointed out here in my thread. Those lows are gonna get revisited in late March. That's there for a reason. What do I like in trading? Okay, and what I'm referring to is this. If you just go to my uh, Twitter here, right? This is my equity curve. Okay, why does it look like this? Well, it's because, and okay, this is not like a ego thing, but you know, if you put that equity curve into ChatGPT, this is what it would tell you. All right, it would tell you this. The equity curve shows nearly uninterrupted growth with only very minor drawdowns. Even professional fund managers and prop traders rarely achieve this kind of smooth upward trajectory for 200 days. In trading, long-term consistency with low volatility in the equity curve is an incredibly rare achievement, especially when paired with significant profitability. Losses are tightly managed as shown by the relatively small red bars, while gains appear both frequent and substantial. Exceptional risk management is one of the hardest things for traders to achieve. Maintaining this for across 200 days is almost unheard of, even among highly skilled traders. 200 days of consistent profitability limits the possibility of luck playing a large role. Right? Okay, so it's not to say like, oh, I'm fucking amazing or whatever. Yeah, I'm pretty good at trading, clearly. I mean, look at the equity curve, right? But why can it look like that? That's my point. Well, it's because in speculation, what I like to do is, as I pointed out right here, I want to identify equal highs and equal lows. When you have a lot of equal lows, what it means is, and I'll just provide an example of something that's played out in real time, right? Here was Ethereum of February 3rd, and I pointed this out, right? I pointed this out, and how this is the same as this. What am I referring to? Well, if you keep jumping on the same floor over and over and over again, and everyone has to put their stop loss and liquidations beneath here, when it goes beneath, it can capitulate hard. So here you had, just for analogy, 1, 2, and 3. In between there you have a 20% bounce, 4, and 5, right? So pay very close attention. 1, 2, 3, 4, and 5. Well, what has happened now? Okay, you bounced off these equal lows multiple times. What has happened to Ethereum? You see what it's done? It's down like 67% from the peak, 66% from the December peak. And the same logic here as on Ethereum is what I believe is going on in Japan. Okay? So when we look at this and we look at Japan, what have they done? Why do they keep bouncing it off of the same level here? Well, they're forcing everyone to put their stop loss and liquidations beneath there. And if people have borrowed cheap yen, what's going to happen when Japan starts to deleverage? All financial markets are going to nuke like crazy, harder than you've ever seen before. And that, along with forced selling from job losses and the VIX spiking because of panic and staying elevated, is what I believe is going to create a generational buying opportunity. But I can't know it certain with absolute certainty. Okay, everything is speculation when it comes to shit like this. But I'm just showing you what I look for. Okay, and why it's so consistent. The market is driven by liquidity. What I mean by that is that for someone big to get filled, they need um, to engineer liquidity in either direction, as in they force. This is manipulation, but that's a good thing. Okay, when you have equal lows like this, if they want to close their short positions, they're gonna buy. They're buying back, right? What's the best way for them to do that? Well, beneath the equal lows, because that gives them the liquidity that they need to get out of their short positions. And same thing on the inverse, if we were to invert this, right? The best way to get out of your long positions and to get your orders, in this case, filled, would be to do what? Engineer liquidity in the other direction. So you have it done here as well, right? And this is what I'm referring to and why I think it's so important. Okay. Now let's go to the S&P 500 and look in prior business cycles if there were some technicals here that also gave you warnings. I mean, a heads up that things might turn around. Let's go to a line chart, right? Why am I on a line chart? Because the RSI uses the line chart. You shouldn't use this for overbought and oversold, but you should use them for divergences. Now you can see we keep making these lower lows here, right? A low here, a lower low, a lower low, a lower low. We made a low here, a higher low, a higher low, a higher low. So momentum is starting to shift. That means that eventually it's gonna turn around based on probabilities. It's very likely that it will. Okay. Same thing in 2002. Look on this bottom was from weekly divergence. Okay. Just like the tops were marked with weekly divergences. Look here, the momentum has started to roll over. The higher high, lower high, right? Most reversals appear like this. Same thing before COVID. Higher high, lower high. During COVID, yeah, you just went straight up because of reasons. It's not the same as now. Okay, we don't have intervention or anything right now. That will come, but that's not right now. Same thing at the low. You can see this lower low, higher low on the other side. Same thing right here. Momentum rolling over. All these lower highs. Yeah, was rolling over, and then it did this. And if you think that's in hindsight, no, like again, I pointed that out there too, right? How the Bitcoin moon boys ignore the weekly divergence. Will the Stonk moon boys do it too? All right. So the divergences are very, very powerful. And I believe you're going to see something similar at the bottom too. Now, based off of daily divergence, you shouldn't just care about that, okay? Because what is the issue with daily divergence? Well, look at the first drive here when it appeared. It appeared with this low, but it kept going lower, right? Like from there, you dropped another like 25%, right? So don't use the daily, but the weekly divergence is pretty powerful, right? I'm just showing you things that I look for, okay? Everything is speculation, not telling you what to do. I don't know where the bottom is, okay? I'm just saying these are the things that I am looking for personally. I'm not giving advice. I'm not telling you what to do. I can be wrong about certain things and all that, so don't come crying to me if I'm wrong about something. It's just to show you this is what I look for. All right? What about gold? Right? Gold is pumping. Is this unusual? No, it's not. Look when the S&P 500 peaked in 2007. The S&P 500 peaked right here in October 2007. Gold kept going up until March 2008, and the recession began in late December 2008. So gold is going up into the beginning of the recession, but then it goes down 34%. And same thing with silver, right? Silver was doing the same thing right there in 2008, right here. The S&P had topped, silver kept pushing up from S&P 500's top, silver went up another 60%, and then it dropped 61% in 7 months from March 2008 until October 2008. Okay, so I don't know where the top is. And I don't know where the bottom is. I can only tell you that, hey, this is what I'm looking for. I'm looking to buy silver somewhere down here. I don't know if we get it. It goes down in recessions, as you can see, historically speaking, because it's affected by the economy, because of its industrial use case. In the green zones, it goes down here. Right? It only went up in this one. It began lower here, then it ended here. Right? So there's no guarantee. There's only a probability. These are things that I'm looking for. I'm looking to buy the S&P 500 and silver if they get cheap. Whatever gets cheap, right? Now I'll inform you what I'm buying, but I'm not telling you what to do, and you shouldn't do anything that I say. Okay? I've been wrong about a lot of things in the past, and I've been right about a lot of things as well. So I'm speculating. I'm looking at data, probabilities, right? And I'm just showing you this is what I'm looking for. But don't do anything that I say. Yeah? You should do whatever you want. Anything else I want to go over? Again, just pay attention. Job cuts 2000, 2008, 2020, and today. GDP contraction. Now the GDP contraction keeps getting updated, right? Because it's GDP now. But you can bounce in the stock market. I'm already saying this right now, right? Like even after this bounce, okay? You could. Let's make a comparison to the Great Depression. This is not my base case, but I just wanted to show you how scary this is. This is 1929 and this is current, okay? Now it bounced back up and now we're like right here, okay? We're right here. The first move down here in 47 days was 22%. The first move down here in the Great Depression was 19%. Then he bounced, then he dropped. Then he bounced, then he dropped. Then he bounced, then he dropped. The overall decline here was 50% down in 71 days. This bounce was, I think, 6 or 7%. This one was 14%. This one was 34%, and none of them were the low. This is not my base case, but I'm just showing you the comparison to show you that so far, this decline is worse than what we saw during the Great Depression. And given the fact that we have negative GDP and rising unemployment, this is the second fastest drop into a bear market for the S&P 500 in the past 100 years. So be very careful with how you interpret that, okay? Because again, as I said, the second fastest when you have negative GDP and rising unemployment. Black Monday 1987, was it even faster? I'm not even sure. Let's see. Let's see. How quick was that drop into a bear market? SPX. Black Monday 1987. Yeah, this was quicker. Or? No. I mean, by this point, we were not even done as much. I don't think this is gonna. I don't think we're gonna get some Black Mondays and shit. Okay, just to show you, this did happen. But this was not a business cycle. As you can see, there's no recession here. Right? Unemployment never moved up here. So I'm referring to the business cycles, right? Unemployment in purple here is trending down. Okay, and there's no recession here. Oh, I just had to mute that. I just sneezed. But yeah, this is to show you what has happened in the past and so on. And it's the second fastest drop into a bear market. The only one that was quicker, as you can see, it's way faster than the drop into the bear market in 2000, 2008, 1974. The only one that was faster was COVID. COVID was the fastest drop into a bear market that we have ever seen. And second on the list is the one we just had now. And the third on the list is the Great Depression. So it's the second fastest drop into a bear market in 100 years. And I have to point this out, right? It's scary, right? In the short term, it's a good thing, right? Well, you did get your bounce, as you saw. I pointed this out a few videos ago. The bad thing is we're seeing signals not triggered since 1929, 31, 32, 33, during the Great Depression, right? And the historical examples here is how bad it could get, right? And these things take 1 to 3 years to play out, right? The 1974 bear market, 50% down, took 22 months. 2000, 31-month bear market, 51% down. 85% in the Nasdaq. In 2008, it was an 18-month bear market, down 58%. In 1929, it was a 34-month bear market, down 89%. This is what they would look like. But you're gonna get temporary bottoms and shit in between. You might only be down 5 to 10% from the all-time high and a potential future higher low. And then everyone is gonna say it's different this time. No, that's consistent with the previous bear market, as I showed you. You know, the lower high right here is 8% from the all-time high, 7% from the all-time high, whatever it was here, and 7% in 1974 as well. It's normal. Those things are normal. Okay? So it doesn't change anything. GDP has to stop being negative. You need to stop seeing deflation, which means demand destruction. You have to stop seeing all these bad signs that you don't want to see for this to turn around. GDP contraction, unemployment has to stop going up. But that's also not consistent with what history shows, right? Look at the unemployment rate, okay? You might say, oh, it's low here. Don't make the same mistake as people have made in the past. The unemployment rate moves in very, very clear directions in this case, okay? Look at this. 0.4% rise in unemployment rate led to a recession. 0.1, 0.6, 0.6, 0.3, 0.5, 0.7, 0.5, 0.5, 0.4, 0.6, instant 0.8. That's large enough to qualify as a recession based on all historical examples. And this is U3, which is designed to look better than it is. Because again, if you're unemployed for 12 months or more, you drop out of the statistics. You remain in U6, which is underemployment. U6 used to be the national employment rate before right here. Here's where U3 became the one instead for national employment rate. If you drive for Uber for 2 hours a week, you're also not unemployed according to U3, but you are in U6. Okay. And don't pay attention to individual months. Like, look at this. This is the trend in U6 unemployment rate. Unemployment is moving up. Okay. But yeah, it can go down in between. That doesn't matter. Pay attention to the trend. And eventually it starts to spike. And the issue is that the stock market has gone down in every example here. Let's just look at the stock market in all of these examples, okay? Let's do this. And yes, I had to draw my own green vertical zones here in these four examples because the US recession indicator doesn't catch it. But you can see whenever unemployment rate was going up here, this is what happened. So let's look at the stock market here. Right? I don't know why this one hasn't updated. SPX. I don't know why it says 59.50. Okay, anyways, it's delayed by a few weeks, I guess. You can see what happens in all of these examples, right? And same thing right here. When unemployment goes up right here, stocks go down. When unemployment goes up right here, stocks go down. When unemployment goes up right here, stocks go down. When unemployment goes up right here, stocks go down. They can still go down otherwise, like here and here and here, but when unemployment goes up, they guaranteed go down every time. You can see here, unemployment up, stocks down. Unemployment up, stocks down. Same thing right here, 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 and now we're seeing the same thing again. It's just this hasn't updated. So these things should not surprise you. Alright? So this is where I believe we are. If I was to guess, like I'm just guessing based off of the past, right? With previous cycles, looking back at this, maybe this is all over in mid to late 2026 or early 2027. If it's really bad, maybe mid to late 2027. That's if it's like the dot-com bubble burst or the Great Depression, because those bear markets were 31, 34 months. But otherwise, maybe it's gonna be a 18 to 22 month bear market, right? All right. Now I think I've gone over most of the things I want to talk about. And again, if you want to be one of those that blames this on Trump and so on, that's fine. But this is you. This time is so different. Everything is so good. 210% market cap to GDP. Warren Buffett says you're playing with fire. Record yield conversion since 1929. Like, you can, you're self-sabotaging. You're ignoring every warning sign. But you do whatever you want. Look at S&P 500 versus the 2-year yield. Interest rates going down is bearish. It means people are buying safe, or they're looking for safety and liquidity. Look at this. In red, you have the S&P 500, and regular candles you have the 2-year yield. When the interest rates go down, it's bearish. Look at that. I've been saying that. It's not a bullish thing. It means the economy is weak. So the most important chart is this one. You're playing with serious fucking fire right now, bulls. Because when the yield curve and unemployment rate comes out of inversion, stocks go down every time. And I mean, you can clearly see it. That's not good. That's a really bad thing. You know what happens to the unemployment rate when this happens. The unemployment rate follows the yield curve. Is this good? Do you think that's good? That's bad. That means you're about to lose your job. Not good. Really, really, really bad. If I was to guess, I think the S&P drops 50 to 70% just to get back to fair value, but it might not, right? So when we're down 35%, you've gone down the average recession decline. I'm not necessarily looking for a number. I'm looking for the process to play out. And you can see the S&P 500 normally bottoms when one sec. Let me just change the color here. Normally bottoms when the unemployment rate has spiked, right? Right here, the unemployment rate had to move up by this much for a stock market bottom. It had to move up this much for a stock market bottom. It had to move up this much for a stock. Well, actually, it wasn't. It was like this much. I don't think it's fair to make comparisons to 1990 because look at the valuations. Look at this. This is a joke. You can drop 50% and still be overvalued. If you drop 50%, you're as overvalued as you were at the 2007 peak before that 60% drawdown began. Okay? So this is really bad. But you're looking for unemployment to spike, right? Historically. And it only takes a 1.4 to 2.1% rise in unemployment rate to crash stocks by 50%. 2.1% rise in 2008, 50% down in stocks. 1.9% in dot-com and 1.4% in 1974. We're up 0.8. And please don't be one of those that says unemployment is so low that everything is therefore everything is good. Yeah, there isn't the same thing back here. It's just silly. Don't fall into the same trap as the people in the past. But you can bounce back, right? You can see the S&P get a lower high, 5 to 10% away from the all-time high. That's perfectly reasonable. So I'm not saying we have to go down now. We have done enough to qualify as the first move down in a recessionary bear market, all right? This is more brutal than 2008, and the GDP contraction is it's contracting harder than Q1 2008. Look at this. Okay? Q1 2008, right here. When I mouse over this, it's gonna say the number here. 1.7%. What was the issue? We're contracting harder than 2008. Okay? And we're selling off faster and harder than in 2008. But you could bounce back up. Like if you repeat what you've done in previous cycles, you could get up to like 56, 70 on the S&P or something. 5,700. Like that is consistent with something that's happened in the past in the 50% declines. And you could be half a year into it. So like this is a possibility. And I would just okay. I know this comment's only going to happen in the future if this was to play out. Oh, everything is cancelled. It's different this time because it's here right now. To whoever says this in the future, I'm gonna pull this up for you, just so I can quote myself here. Okay, this you could be right here by September. That's consistent with what happened in 2008, in 2000, and in 1974. But in the 5 months that followed it, 6 months that followed it, you dropped 50% from that point. So my guess is somewhere down here, late to mid to late 2026, maybe into 2027 if it's really bad. But I'm just gonna be guessing based on like speculation and shit. I'm just looking for something to get cheap, not getting the bottom. I don't care. Maybe I buy in a bit early, maybe I buy in too late, right? And it doesn't get back down to fair value. Well, then I'm not gonna buy because I don't buy overvalued shit. Okay? I don't wanna chase bubbles. Like you shouldn't be bullish here. Look, this is so dangerous. Warren Buffett says you're playing with fire. Another sign that you could look for is Warren Buffett saying he's buying, because in October 2008 he did. Buy America I am, right? Here. If he publishes something like this, like in October '08, the financial world is a mess, and in the near term, unemployment will rise, business activity will falter, and headlines will continue to be scary. So I've been buying American stock. When you see shit like this, and you can see he's talking about the Great Depression and so on. When you see things like this, and he has $400 billion in cash right now, he will deploy it at some point. He's looking to get confidence back into the markets at the same time as well, and a good opportunity. That's when you want to be buying, not when there's hype, man. Right? But again, you could bounce even harder. It's possible. But I just wanted to pay attention, right? And you're not living through good times. The comparisons to yesterday's bounce. The Great Depression, COVID, global financial crisis, Black Monday 1987, Great Depression, today COVID. Nice. Great times. That's all. Peace.